Hey folks, welcome back. I wanted to make this a quick video to talk about what happened last week. I've been kind of off of YouTube for the past week or two, partially because I've been working on some really exciting side projects, and also because I wanted to take a little bit of break from the YouTube stuff and to actually dive into the finances and focus in. So, to go over what happened last week, on September 11th, what we had was a CPI report that ended up actually being higher than the forecast. So, consumer price index being higher, of course, that indicates inflation. The day before that, on Wednesday, was the PPI report, which said that the producer price index was lower than the actual forecast. The actual was lower than the forecasted. So that's good because it means that the producer price index is going down. That means that stuff is cheaper for producers, but unfortunately, what it seems to suggest is that things are a little bit more expensive for consumers. Who benefits in this kind of market? Well, on Wednesday, what you saw was semiconductors went up a lot. I think it was a 3x leverage semiconductor ETF that saw 5% increase within just this one day on Wednesday. Now, on Thursday, the market still continued to go up. This ties back to something that I've been talking about previous, where the economy is going to go into a K-shaped recovery similar to post-COVID. What does that mean? K-shaped recovery, think about the letter K. So there are two different directions that stem off from the vertical line. What ends up happening is stocks will go up, assets go up, housing prices go up, but unemployment goes up as well. In other words, the number of jobs available goes down. The number of people who are employed goes down. The standard of living that people want to be able to afford is more difficult. And so we saw that with unemployment rates in the past couple of months. This is big because what it means is the economy is not necessarily doing that great, but prices of stuff is getting more expensive. This is starting to sound a lot like stagflation, where you have a stagnant economy and there is inflation. Now, why are stocks continuing to go up? Because where else do you put your money? You're not going to put your money in US dollars, because those are going to be inflated away. In other words, the price of your $100 is only going to be worth, maybe, let's say, for example, only worth $99 next week, or $95 3 weeks from now. So why would you hold on to something that's actively losing value? This is why there's a lot of money that's moving into gold. I've been making a very good amount of money by betting on gold. Now, again, this is not investment advice. This is just information to help teach you my mindset and how investors think. Now, I am 3 times leveraged on gold specifically because I'm very bullish that gold will go up as interest rates come down. The Fed is almost 100% certainly going to cut interest rates on September 17th, which is this coming Wednesday. That's when you have the FOMC statements, et cetera, et cetera. This is really important because I think one of the most impactful things that the government or the Fed can do is to lower interest rates. Everything's going to start shooting up again, similar to during COVID. That is my personal hypothesis. And if they start turning on the money printer too, then everything shoots up even more. I don't think they're necessarily going to do that because that would cause more inflation, but they do want to make it cheaper to borrow money so that businesses start hiring more, start trying to spend more, and trying to open up more jobs. So hang out, folks, and stay tuned for more because there's a lot of exciting things happening. But what I personally am following are gold in this 3 times weighted value. Sorry, this is on Robinhood right here. So gold, GDXU, this one is 3 times leverage. This is for day traders. Now, day traders will usually buy this and then sell it sometime during the day. FNGU, same thing. This is FANG stocks. This is tech. It's 3 times leverage. So if it goes down 1%, you lose 3%. So you lose 3 times as much of your money if it goes down. But I am watching these two things. There's another very interesting thing that's happening that also happened during and post-COVID. GameStop. So GameStop started going up like crazy. And what I'm seeing right now is in the past couple of weeks, past couple of months, I keep hearing people talk about open, this particular this particular symbol right here. Now, what is it about open that's so interesting? I think it's because the movement is really similar to GameStop, where you had a bunch of people doing a short squeeze on this particular stock. You can see in July it was basically a penny stock trading under $1. All of a sudden it has a run up in July 21st, and then it goes back down to nowhere. Now, I started following around the July interval, and I saw all these people talking about on Reddit, open door, but I didn't really think much of it because frankly right now nobody is buying. You see the real estate market, it's really bad because there are very few buyers, but prices are still staying super high because I think people are unwilling to lower those prices. Now, as time goes on, eventually there are going to be people who maybe start losing jobs or who have to move or something like that, and they need to start liquidating assets. So those people may, in fact, start selling their houses at real market rates, which are probably going to be much lower. So if that happens, then there could be potentially a lot more opportunity to supply and demand for these housing. But I don't personally know that much about the real estate market, and I personally don't know a lot about Open Door, which is why if I were to play this, I would treat it like a gamble, like betting on red at a casino or something, because frankly, the valuation and the way that this is moving is very, very similar, in my opinion, to GameStop. Do I potentially want to play that kind of casino movement? Maybe, but that's going to be more out of a fun money. I'm not going to try to gamble any kind of serious money on this because that's what it is. Flipping a coin, basically. That's my personal opinion on this. I think it's very dangerous and folks should probably stay away. The other one that I find personally very bullish on and interesting is Robinhood. So Robinhood recently made the announcement that they would be joining the S&P 500. So that's going to be really exciting. And you can see there's this massive boost from September 5th to September 8th. If we zoom in on this over the past month, what we see is over the weekend, there's this massive bullishness on Robinhood because what happens is all these pension funds, all these big hedge funds that just buy SP 500 every so often, they will basically just always buy whatever SP 500 is. And if SP 500 includes this, then they have to adjust it too. So lots and lots more people are going to start flooding their money into companies that are in the SP 500 like Robinhood. Now, if you look at one of their competitors, IB, which is Interactive Brokers, they also do some finance stuff, basically give you a platform to make trades and things like that. But one of the biggest things that I found difficult when I tried signing up for an account with IB was the fact that I had to have a minimum amount for my trading account, something like $25,000 or $30,000. Now, when I was younger and I didn't have that much money, this was completely inaccessible for me. So I couldn't do programmatic trading, which was really frustrating to me. Now, you can't do programmatic trading through Robinhood, but it seems like with a lot of stuff they're starting to offer, first it was crypto, then it was options trading, then it was no, excuse me. I think options trading came before crypto, but you get the point is that they're offering more and more features. And now they're offering something that's really interesting that this news has just hit my news feed 7 hours ago. They're going to potentially have a publicly traded venture capital fund. So what that basically means is there's tons of private companies that don't want to go public because maybe it's easier to raise money privately. Maybe it's easier to hype something up if you don't have to show so many documents, or people won't be as scared to invest in it if they don't see certain documents. And so there's tons of money flowing through these private companies. Now, Robinhood is potentially going to open up that access to a lot of retail investors, people who don't have a lot of money or people who are average Joes. That is massive. I personally am very bullish on Robinhood. Again, this is not investment advice, but I personally am really interested to see where this goes. I use Robinhood even though there are other places which other people claim have better fees or which have better X, Y, or Z. But I use Robinhood because it's the most accessible. It's in an app right there on my phone. I tried using Fidelity to do trades and to do options and things like that. Really difficult. Found it completely inaccessible. I still use Fidelity for some stuff, but I usually use it to buy and sell. I mean, I was thinking about maybe using Fidelity more because I wanted to consider shorting some stuff. But now Robinhood could potentially also offer the ability to short stocks. Robinhood and shorting stocks. If you see, they just added it, I think, yesterday. Yeah, so they're starting to allow short selling, which is very interesting. Now, there are certain limitations, like, for example, during the GameStop massive event, there were a lot of people who were saying, oh my God, Robinhood doesn't actually have the stock when I buy GameStop. They have to go and get it from somewhere else. So what you're paying for is actually just a promise that they'll get the stock for you. And people were kind of up in arms about that. But honestly, what do you expect from a company that offers you something for free? They're going to try to make money from that somehow. They have to. Otherwise, why would the product be there? And if the product is relatively good, it's accessible, you're able to use it for the intended purposes, then is it really that bad if they're making money from it somehow? There's payment for order flow, which is another big problem people have with Robinhood. My opinion on that used to be pretty negative, but I think I've started to come around to it because as long as you're not playing things that are really illiquid, which I don't think most people should or most people want to, then I think that you will probably be generally safe, but they take money from a lot of suckers. So you do have to be careful and look into that kind of information, like payment for order flow, um, because you have these larger funds that will come and try to make trades based on the things that you do. So if you say I want to buy 100 shares of Robinhood or something, then somebody else might see it and they say, "Ooh, yeah, well, then I'm going to jack up the price temporarily just for you." And then you're going to pay a higher price for that. So usually you can get around that by setting a limit, saying I will only pay, let's say, $114 per share of Robinhood, and I want 10 shares of that or something. So then, well, the market has to either accommodate you or you'll just never have that order filled. I think that's a much more healthy way of going about it. You don't really need to sweat it too much, although, yeah, people are probably making some trades against you. Generally speaking, though, most people shouldn't even try to day trade. So if you are going to buy these things, payment for order flow kind of doesn't matter as if you're a long-term investor, because they're not going to impact whether it goes up a year from now that much. So especially if it's a stock that's got a lot of money flowing through it, if it's on the SP 500, generally the case. So anyway, let's go ahead and continue watching these things. I think Wednesday is going to be really interesting to watch what the federal interest rates end up cutting, because if they don't cut, that's going to be really scary to the markets. The markets are pricing in at least a 25 basis point cut. If they cut more than that, that could actually be really bullish. So yeah, see, there's a 98% chance that they're going to cut by September. Now, the only question to ask is how much is the cut? So if we go ahead and look at what Polymarket is saying and how much money is saying that, let's go ahead and see right here. There still is an 8% chance, according to Polymarket, that there's more than a 50% basis point or 50% basis point decrease. But the majority of people think it's just going to be 25. So we'll see. And again, this is not for you to trade on. This is not investment advice or anything like that. I just want to keep you informed. How do I feel about this kind of information? Well, there is $130 million behind these bets. I think that it can be relatively reliable to think about from this perspective. If there was only, let's say, 10 or 15 million, I'd be much more skeptical about these numbers. Anyway, I hope that you guys are all staying safe and that you guys are enjoying yourselves with the start of fall. I think most of summer is basically over at this point, and I hope you're all having a good time, whether that's in school, at work, wherever. I really wanted to just drive home the point, though, that the economy is potentially a K-shaped. So there are a lot of people who are struggling out there, and I want to be cognizant of that. Just because we are making money here or just because we want to doesn't mean that we have to step on those people who aren't doing well. All right. Thank you guys so much for your time. I hope that you guys continue to stay watching my videos, and hopefully I can keep you informed. Have a good one.